Good afternoon, everyone, and welcome to this webinar in our series this week, looking at trusts that have won a rating for 2025. Shortly, we'll be hearing from Doug Ledingham, who'll be talking to us about Pacific Assets, one of the winners of the growth rating. And Doug will be talking us through how he's gone about achieving the attractive risk-adjusted returns that Pacific Assets has delivered. Before we get started, hopefully everyone by now knows the drill, but a reminder, if you don't, that if you'd like to ask a question, please write the question in the box on the right of your screen. I'll put those to Doug at the end. We should have 25 to 30 minutes or so for the presentation, and then 15 minutes or so for questions. So with that, Doug, I'll hand over to you.
Thank you very much. And yeah, thank you very much, everybody, for who's joined in today. Yeah, rough overview of what I'm quite keen to cover. It would be the philosophy by which we manage the trust, the key outcomes of that philosophy, and then touching on the portfolio and hopefully some opportunity to talk in depth about some of the companies that we own on your behalf. So firstly, this is the key principles by which Stewart Investors have managed our clients' capital since 1988. We had the privilege of taking over the Pacific Assets Trust in 2010, and this is these are the key principles that we've used to since that time. Very much underlying everything that we do is that absolute return mindset, and by that we mean very much seeing risk as the risk of losing your money rather than deviation from any benchmark. So that's very much the kind of foundational cornerstone of how we think and how we approach the very important job of stewarding other people's capital. From there, we find ourselves naturally taking a long-term perspective. So at time of investment, we are trying to take a 10-year view. And just by taking a longer-term time horizon, we kind of seek to avoid a lot of the noise that we're bombarded with today, and by taking that longer term view, we have the ability to focus on a slightly more simpler investment case and focus our analysis on more enduring aspects of a business, in our belief that it's those enduring facets of a business that will drive value over time. And as long-term owners, we're seeking to allow the trust to benefit from that underlying growth, rather than us trying to be too smart and trade in and out on short-term volatility. With that 10-year time horizon, again, we find ourselves really getting to two lenses by which we look at companies, quality and sustainability positioning. And I think most managers would sit in front of you and say, we think and care about quality, but for us, I think we do have a slightly differentiated take on that. And that really comes with our focus and emphasis on the people that we are handing your money to. That's a very important part of how we spend our day. The key parts of our debate and analysis is very much understanding the time horizon, the competence, the integrity of the people we're handing your money to. And that's really driven by our belief and experience over the last 30 years that it is the people at the top, the culture, the way that they behave with minorities' capital that drives whether value is created or destroyed over the long term. Sustainability, we have long seen sustainability as a core bottom-up input into how we analyze companies and allocate our clients' capital. It's not an external part of our analysis. We're not utilizing third-party ESG scores. For us, again, sustainability is, if we were going to own a company for 10 years, we want that company to have tailwinds at its back. It's very difficult, we believe, to own a company where that growing risk of either government regulation or changes in consumer preference around perhaps climate change or diets. These are key headwinds, key risks to companies' cash flows. That feeds into stock prices and ultimately our clients' capital. So as I said, these are the key foundational points that we've used for the last 30 years. Here, very quickly, we've created this slide just to provide some key outputs that come from our philosophy, and very much wanting to prove that we are walking the talk when it comes to the philosophy, our philosophy, rather than saying, we do a whole host of interesting things and then end up owning a portfolio that looks and behaves very much like the index. So on the left-hand side, risk is the risk of losing your money. And we have a very high active share, and we have a portfolio that looks and behaves very differently to the index. And you see that in the outperformance in down markets, and also that downside capture number really, when the market has tended to fall, we tended to fall a lot less. And that's really a function of who we're handing your money to, long-term stewards who have their own money invested alongside us, very strong balance sheets. And that's been a very strong foundational component to the long-term compounding of the PAC Assets Trust. That middle column, long-term time horizon, we are, I hope, walking the talk here and being long-term owners of companies. You can see that in the turnover, and then also the number of years by we've held the top 10. On the right-hand side, just a simple set of outcomes in terms of our approach of applying quality and sustainability positioning. That holdings with stewards. By stewards here, we mean economic owners in the form of either a family or an entrepreneur or a foundation that has their own economic wealth, reputation, invested alongside us. That's a very strong driver of how we think about preserving and growing your capital. It is finding these great people to hand your capital to, and where there isn't that identifiable institution or owner that we can back, we spend a lot of time understanding the culture and the behavior of the executive team, in the desire to find those similar qualities that I've touched upon here in terms of time horizon and competence. Holdings with net cash balance sheets, that is for us another outcome of handing your capital to stewards that think with a long-term time horizon. These people have been around for a long time. They understand that the world is inherently unpredictable, so they like having balance sheets with redundancy, and that's vitally important when that inevitable down cycle happens. Like we saw in COVID, nobody predicted COVID, but the vast majority of the companies in the Pacific Assets Trust with very strong balance sheets managed to maintain their independence. When the world was falling down around them, they weren't subservient to creditors or the market in terms of capital raises. They had the ability to maintain a long-term time horizon and invest counter-cyclically, and that really is a key source of outperformance over time, is really backing those people that can maintain their independence that when everybody around them is losing their heads. I'm going to quickly jump through to some of the key outcomes that we believe that the Pacific Assets Trust delivers over time, and here we've got the performance of the trust over many different time periods, rolling 10, 5, 3, down to 12-month periods or 1-month periods. We as a team, a culture, a philosophy are very much focused on outperforming in the top part of that chart. It's very much where we believe that long-term time horizon, the emphasis on people, the emphasis on capital preservation, the longer the time horizon, the more that those kind of values and facets have a driving force behind returns. That's really what we're looking to deliver, and it's really what we're hoping that shareholders of the trust are aligned with, and what they're hoping to achieve. I think all philosophies, if you are consistent in philosophy, you have to be willing to trade off something, and for us, we are willing to trade off that constant desire to outperform every short-term time period. I think if that is your end game, it's impossible to have a consistent philosophy, and ultimately very difficult to preserve and grow clients' capital. So for us, very much that consistent focus on trying to deliver long-term returns for underlying shareholders. This is another way of expressing the performance of the trust over time. Relatively complicated chart, I think, but it's simple in what we're trying to say, in that these are all rolling 1-year periods of performance. Anything below the line is underperformance, and anything above the line is outperformance. You can see on the left-hand side of that chart, the trust has, and our philosophy has tended to preserve capital a lot, better than our peers and the index, and that really has set a strong foundational point to compounding. On the right-hand side of that chart, you can see that we tend to underperform fast-rising markets, and again, these tend to be markets driven by a little bit more greed, perhaps slightly more untested business models, driving markets, and then maybe a slightly less focus on valuation. So these are the types of markets where you tend to see us underperform. But hopefully you can see that, we're not giving up much in the way of absolute performance. So with this, trust, we are managing downside risk while being able to capture that long-term growth. And finally, just on outcomes, I think this is another important way of just identifying the differentiated outcomes that our philosophy delivers against both the index and peers. So on the left-hand side, you have active share against downside capture. High active share, hopefully, again, that shows that we are very much walking the talk on being truly bottom-up allocators of capital, starting with a blank sheet of paper rather than, working back from a benchmark. And then that downside capture, not only are we owning companies that look different to the benchmark, but the characteristics of those companies have historically tended to do very well in times of stress. On the right-hand side, outperformance versus volatility, and again, hopefully this expresses that differentiated set of outcomes that our philosophy delivers. Historically over time, it has delivered outperformance with a lot less volatility, and volatility is not really how we would describe risk. As I said, it's the risk of losing your money, but given that we are owning more tried and tested business models that are less fragile, when the world is falling apart, historically the trust has tended to be a lot less volatile than the index and peers. So here we have the positioning of the trust at the moment, and for those shareholders that have monitored the trust for a long period of time, you will know that India has been a favored home for our capital over the last 10 years, and that's really just a function of our bottom-up process. We are very much spoilt for choice in the number of high-quality, world-class people that we can hand your money to. We're also beneficiaries of a very broad and deep market, in that in India, you are able to gain exposure to a number of very interesting trends through a broad market, rather than in many emerging markets being forced to own a telecom company or a retailer. Despite that consistent weight in India, our underlying exposure has evolved over the last 10 years. If you looked at the trust 10 years ago, there would have been a lot more generic pharmaceutical companies and consumer companies, and the trust has been a major beneficiary, I think, especially of the evolving landscape of the Indian equity market, especially the emergence of a number of world-class industrial companies. In our view, are not only very well positioned to benefit from domestic growth, but are highly ambitious in their global aspirations to take on global multinationals. China, again, bottom up, has historically been a place where you find a lot less opportunities to hand your capital to world-class people. The vast majority of the market there is state-owned or implicitly state-controlled. And again, for investors who spend so much time and care so deeply about who we're handing your capital to, it's a relatively simple decision on our part not to hand your capital to the state to manage. So in China, we are able to find privately owned enterprises that we're comfortable are very much aligned with where the Chinese Communist Party needs to take China, and where we do believe there's an attractive opportunity to grow earnings at reasonable valuations. Sorry to jump about a bit, but I think this is an important way of expressing what we do with your capital. And we've just looked at geographical exposure. I think this is an important outcome, and I think an important thing to consider. Remember, when thinking about the Pacific Assets Trust, is ultimately when you look at Pacific Assets, where's my money ending up? And this chart shows that there is a lot of that money that's handed to families, families that are, in our view, given the freedom to think differently to their peers. In a world that's increasingly short term, whether it's from an investment perspective or a business perspective, that freedom that comes with being an economic owner is vitally important. And I would even go so far as to call it a superpower in today's markets. If you have that ability to think differently, you have the ability to change the outcomes. And for us, finding people that can take that long-term time horizon, who have the ability to invest in building a better business in 10 years, rather than a better business in the next 10 quarters, is a key driver of what gets us excited about being able to to invest your capital in Asia. It's a home to some wonderful people, but as we all know, as you see in the the FT and other newspapers, that emerging markets in Asia is home to some very questionable families, and some of which have some Bond villain type tendencies. And so for us, we're not blindly looking for family-owned companies and handing your money over. We understand that the ability to take, or the ownership of a family creates that ability to build exceptional returns. But for us, that's only where our analysis starts. From there, we're looking for those characteristics that lead us to those really exceptional returns. You can see here that, again, our bottom up approach means that we are really owning companies that look and behave very differently to India Incorporated and China Incorporated. And again, hopefully this feeds into that view that we're not just closing our eyes and handing your money blindly to anybody and anybody. So in India's case, you'll see that despite our enthusiasm for that country as a home for your capital, in the top 100 companies, there's really very, very few who we're comfortable investing alongside, and that would be a function of either the company being state-owned, the company being run and operated by people that we're really, really uncomfortable handing your money to, or franchises that we have question marks over their quality or long-term sustainability positioning. In China, as I mentioned, the vast majority of the large companies are explicitly state-owned or implicitly state-controlled, and for us, that's a very simple decision. Here, I think this is this is not there's information and research here that's, I don't think that's spent or given enough time in the investment universe. That family-owned companies, through numerous pieces of research, have proven to outperform across countries, across sectors, and across time. And it comes back to that point on being able to take a long-term view, being able to invest in R&D, importantly, being able to manage the business for survivability. Rather than maximizing the business for the next quarter, families have the ability to build in that redundancy, and focus on, if I'm going to work back from preserving and growing my family's wealth of the next generations, how do I ensure that that's not disrupted? And certainly the building in redundancy, taking that a broader perspective to how the business is operated, rather than simply for the benefit of minority shareholders. The companies that we're owning across Asia, because of that family ownership, because of that the time in which they've been around, the fact that a lot of them have the family name above the door, a far broader approach to how they manage the business, how they think about risk, and you really see them taking a more holistic view of their role in society and their social license to operate, which I think is very difficult to stick into a discounted cash flow model, or, again, coming back to our industry's desire and want to stick a decimal place against something. It's it's something that we as a team, we care so deeply about analyzing and debating people, but it really requires a small team of generalists, who believe so intently that it matters to our clients' capital and who we're handing it to, and a reluctance on our part to get drawn into short-term noise, a desire to put a decimal place against everything. And those bullet points on the right-hand side, these are this is the statistics coming out of the US, but I think globally you are seeing similar pressures on companies where you don't have a long-term owner. Very limited tenure of executives, and growing evidence that those executives have an inability to invest in long-term value creation. For us, it's a very risky proposition, handing our clients' capital to an executive who is looking to maximize the value of the business over the next 10 months rather than the next 10 years. And that's why you do see, in terms of the Pacific Assets portfolio, very much the majority of your wealth and the assets of the trust being allocated to families. Coming to some of the more structural points, actually here is, if we're looking to analyze and build a picture of the people you're handing your money to, we are forced to do our own research and build our own third-party networks. It's very difficult for us to lean on investment banks to deliver the kind of analysis that we're looking for. If we were to read a 100-page initiation report on a company written by one of the bulge brackets investment banks, there would be at most maybe one paragraph on the people, and it would largely just be a biography of the CEO. No view of culture, no view of historical track records, no view of holding companies. So for us in India, Southeast Asia, and China, we've developed third-party providers that we can really utilize to build a broader picture of the quality of those people that we're investing alongside. And we've got some examples here, one of which is in China, where an R&D center was found to be a hotel. But there's numerous examples of companies that we've looked at where the listed entity looks very exciting, but where outside of that you'll have numerous unlisted entities where the founder or the entrepreneur has the ability to leak capital, to leak profits out of the listed business at the expense of us as minorities. And that's takes us back to why we spend so much time being skeptical and really digging into the weeds of the behavior of the people behind businesses. And this is an industry where we spend a lot of time saying past performance is not a guide to future performance, but certainly in the behavior of the people that we're handing your money to, the tendencies of a culture, we do think broadly that there is a consistency in that approach, and that by studying track records and how companies have operated in the good times and the bad, that we can get a greater understanding of those behaviors going forward. And coming back to my point earlier on COVID, we built the portfolio. Well, when we build a portfolio, we're looking at a portfolio that's robust and resilient to most macroeconomic environments, that's robust to most changes in political power or inflation or interest rate cycles. And we didn't predict COVID, but we were very sure that we'd handed your money to very strong businesses with people that had the ability to think differently. And we were very, very pleased to see that the majority of our companies came out of COVID with greater market share and a greater relationship with their employees and their customers because of how they operated in that time of stress. And we didn't put that into any financial model. It was very much built on meeting management teams and analyzing their track record. And that's why that quality aspect is vital in how we allocate your money. These are coming back to India, and why we are so comfortable investing a majority of your capital there. We do believe that India is very well positioned today, thanks to a number of trends that are coming together. Since Modi's ascent to power 10 years ago, he has invested considerably in improving India's global competitiveness, whether that's improving labor laws, reducing taxes, introducing production-based incentives. At the same time as geopolitics is increasingly volatile, and you see multinationals globally, especially in the US and Europe, waking up to the fact that they've bet the farm on China as their main source of outsourced supply chain. Now India, thanks to the world's largest population and median age of 35, you do have a very attractive demographic in which to develop an alternative manufacturing home to China. Got more attractive wages. You have a well-trained, educated workforce who is English speaking, and that chart on the right that shows the percentage of iPhones globally that are produced in India, I think, is a strong both quantitative and qualitative outcome in regard to how far India has come as an alternative source to China. I read last week a survey that suggested that of the European companies that are looking to allocate away from China, over 2/3 of those were looking at India as that alternative. And I do think that if the geopolitical environment that we find ourselves in today had happened 10 years ago, India was in no such position to be able to offer itself as a high quality alternative, but very much finding itself at a point in time with these two trends coming together and being able to own world-class industrial companies and consumer discretionary companies in India, and in our view at very reasonable valuations, is a wonderful place to be. And coming back to that point and being long-term owners and not being overly focused on short-term macro noise or short-term share prices, and getting out on the road, sitting across from executives and having conversations on where they want to take the business, where they're enthusiastic and excited about investments that they're making today that will bear fruit in 5 or 10 years time. That's where we believe that we have an alternative approach to many in the market in terms of our ability to take a genuinely long-term view and back those management teams that have the capacity to think and act differently and create those differentiated outcomes. So finally, just before I stop talking, to reflect on the historical performance of the trust, as we see the ability to preserve capital on the downside, while being able to capture a lot of the profit growth available in the region has been a strong combination for the trust over time. You can see in those calendar years where there has been strong down markets that the trust has been able to preserve value better than the market, and in those up markets or strong up markets not being able to keep up, but hopefully delivering attractive absolute performance. So very much, I think this is a trust that's I don't think is the right one to own if you're looking to time Asian markets. Very much, if you are looking to come on a longer term journey to Asia and look to outperform with those 10 and 5 years, and I think this is the trust for you. Thank you.
Great, thanks, Doug. We have a few questions that have come in already, but if you're in the audience and you have a question, we have 15 minutes, so we should have plenty of time. So please do add to those. So you did discuss India a fair amount.
Yeah.
We had a question on that, but also about perhaps the risks to consider, perhaps particularly in the light of Modi, whose reforms have been very important, but he now has a smaller majority. Are there any risks that you're conscious of in India right now?
Yeah, so we tend to think a lot about risk. For us, when we are allocating to India and across Asia, we're always looking to minimize that political risk. So owning companies that really survive and prosper no matter who's in political power. And you'll see that expressed in the portfolio that we don't own any construction companies or any company that's purely dependent on a small number of high value projects where there tends to be a greater need for connections in government to get those kind of projects. And for us, we much prefer companies that have tens of thousands or even millions of customers that are parting with their cash on a daily basis. That provides the resiliency and the ability to mitigate political risk that that we're so keen to do. We were actually relatively positive in that Modi's power was curtailed somewhat. I think he was perhaps moving too quick a pace down the kind of strongman route. So to have that influence, curtailed somewhat was a relative positive in our eyes. And yeah, given those longer term opportunities for India in terms of the growing consumer base, those really world-class, highly ambitious industrial companies, we do believe that the opportunity set is attractive enough for these companies, and they shouldn't be solely dependent on a strong Modi government who would, perhaps push more intently on that capex side of things.
We have the performance slide in front of us, so might be a good opportunity to answer this question. So you also have an open-ended Stewart APAC Leaders Fund.
Yep.
So the question's asking about if you could comment on the relative difference in return. So generally speaking, they tend to be quite close, but over the last 12 months, PAC has underperformed. Why is that?
So if we look at purely NAV performance, I think so the difference between Pacific Assets and the Asia Pacific Leaders is Leaders has a greater weighting towards large and mid-cap names, and with Pacific Assets, given the closed-ended nature of the vehicle, we have a greater ability to own smaller cap names as higher weightings in the trust. So over the last 5 years, you have seen some of the names in Pacific Assets, those smaller industrial names that we've been able to own earlier in their journey, have been strong contributors over the last 5 years. Now, over the shorter term time period, we have seen slightly more weakness in the smaller cap names, which would have driven that divergence. But broadly, between Pacific Assets and Asia Leaders, it's the same philosophy, same process, same team. The major difference being driven by whether the names that we are able to own in Pacific Assets, so smaller cap names, are relatively outperforming or underperforming. And yeah, over the last 5-year period, you've seen strong contribution by these smaller cap names. Over the shorter term time period, and especially the last maybe 3, 4, 5 months, and where you've seen a bit of weakness in some aspects of the Indian market, that has influenced the Pacific Assets Trust more. But yeah, that's the major driver of the divergence in performance.
And you described your long-term time horizon and the advantages of that, but is there also a drawback? Does it bring a reluctance to sell companies that aren't performing? How do you deal with that?
No, thank you for that one. It's something that we very much we discuss and focus on a lot in terms of learning from our mistakes and ensuring that any biases that our philosophy will have, and all philosophies have biases that are they're not influencing the outcomes in too much of a negative way. So we are very keen to ensure that we don't fall in love with companies, and with that, we're very keen that there's no individual in the team that will have ownership of a particular stock, and that we're ensuring that every person of the team will meet a company, and that the analysis of an annual report on a yearly basis will be circulated around the team, that allows us to take hopefully a differentiated view, and that rather than a single point of failure in the team, and perhaps an individual ego is getting in the way. And for us, we're always trying to ensure that client outcomes come ahead of team outcomes, which come ahead of every one of us as an individual. And this is, as an industry, it's very easy to let egos get in the way. So trying to set ourselves up as much as possible to ensure that client outcomes are first and foremost in all our minds. So yeah, one aspect is the ownership of the companies being passed around the team The other is not being so we are not being not allowing the portfolio and the activity in the portfolio to be driven by a particular turnover number. I think turnover in itself should be a reflection on our part and where we see opportunities outside the portfolio, or where at particular points in time that perhaps there's some parts of the portfolio where we've got winning conviction. So it's being able to hold our hands up and say we've made a mistake, and allow perhaps turnover to creep up in some instances where that allows, and not be purely headstrong in this idea that to be long term it means you must never sell a company.
We had a question about South Korea. Could you tell us a bit about the sort of opportunities you're finding there? Traditionally, there's been a number of challenges around governance, ownership, dividends, and the like. But yeah, so it'd be interesting to get your thoughts on that.
Thank you very much. Yeah, so the majority of our South Korean exposure will be through Samsung. As a business, I think Stuart Investors has a kind of long and storied history with the Samsung Group. Probably going back 15 or 20 years, we were probably one of the largest foreign owners of the Samsung Group. For us, when we think about the quality of people aspect of our framework, competence and integrity and alignment are key facets of that. And we've never really questioned the competence of the Samsung Group, but we really struggle to understand or gain confidence in our alignment with the family and their involvement in the group. We try to constantly revisit companies, ensure that we're not dogmatic in our views. And really over the last 12-18 months, we have seen a number of cultural changes within the Samsung Group. Whether it's the family choosing to pass on the key management responsibilities to senior executives, seeing senior executives come out in the public sphere and apologize for their lack of performance, especially in the memory market, and then also the implementation of a stock-based remuneration structure, which again for us I think is a strong signal that there is an underlying desire to change. So yeah, we bought back into Samsung 12 or 18 months ago. That was obviously far too early, and we've unfortunately lost money there. For us, like I said, we do believe that there's important change going on internally at Samsung, and we are attracted to companies that have clouds over them at the moment. With the Samsung Group trading at a valuation close to 25-year lows, with considerable question marks over their success in high bandwidth memory and logic semiconductors. There's obviously a lot of question marks, but for us at the moment, those valuations, a very strong balance sheet, remarkable cash flows. For us, it feels like a reasonable place to allocate some of the trust capital, and that we very much believe that people change and the time horizon over which the Samsung Group has the ability to operate will eventually allow it to build, in our view, strong, robust businesses and in these new endeavors, and at a valuation that hopefully provides a reasonable amount of downside protection at the moment. So yeah, as the question alluded to, I think South Korea has long been held up as a place where there needs to be a greater focus on minority shareholders, and whether we've seen in Japan with the regulator and stock exchanges coming in and imposing change, kind of top down, with a kind of carrot and stick type approach. Don't really, our views, perhaps that's not the right way to, or you're never going to see material change. I think the Samsung Group, due to this pretty considerable underperformance and share price weakness, has been forced to wake up. And as I said, we're keen to look for strong signals that things are changing, and rather than just introducing a new slide in an investor pack with shareholder return or return on equity target, we're looking for strong signals of change. And we do think that implementation of a stock ownership program, the humility of the management teams to come out and express, that public apology is, for us is something at least worth backing, especially at these valuations. So continue to, keep a lookout of in South Korea. There's a number of really interesting smaller cap names that exist outside of the large chaebol type businesses. But for us, just the valuations at the moment are not conducive to starting a new position. But we are in the process of planning a trip out to South Korea to to get our hands dirty and have conversations with management teams about just how serious they are about fundamental changes to their culture, rather than it being more of a kind of top down platitudes.
A couple of people have picked up on India. Is that having such a large position contradictory to downside protection approach? And I think you touched on on valuations, but could you perhaps tell us whether you view it expensive at the moment still?
Yep. Yeah. So for us, when we think about creating that portfolio that's robust and resilient to most environments, and thinking about diversification, we are very much trying to look at diversification in the real sense, in terms of where are their period or where are the underlying companies, where are those cash flows being generated, where are they potentially at risk of a particular point of fallen demand, rather than simply taking MSCI's view of sector exposure or a top-down country allocation. And like I mentioned, in India, we are very fortunate that it's one of the most diverse markets globally. I do have quickly jump to this slide because I think it captures it quite well. Is the weight of the top 2 sectors in a country index, and you can see that India is very much on that right hand side of the chart, and shows you just how diversified the index is, versus the left, where you've got Taiwan, which is purely tech, or Russia, which is largely oil and gas and financial. So with India, we do have the ability as bottom-up stock pickers to go where the opportunities are presenting themselves, rather than simply owning an index or being stuck with a purely thematic perspective. In regard to where the diversification is at the moment, we have industrials, we have consumer names, we have IT services companies, which generate the vast majority of their sales outside of India, which is an important driver of hard currency returns. And then in regard to valuation, certainly there has been pockets of euphoria in India over the last 12 to 18 months, very much in the small and mid cap space, and largely driven by the retail investor. I think India in holdings of foreign investors is now at a 15-year low. I think as a function of perhaps macro concerns, or an inability to look beyond the US, or India falling foul of being constantly compared to China, and being seen expensive versus China, although those markets being very much built from different sets of companies, different sets of management teams, and a different view of the role of private enterprise and economic growth. So for us in India, we have actually, you won't see it so much in the exposure, but 12 months ago, India weighting would have been closer to 45%, and within that, they would have far greater weighting towards tube investments, CG Power, Mahindra. These are companies that have done well over the last 5-10 years, thanks to us backing early on a very important structural shift in the quality of these franchises. But we have been forced to materially trim those positions. We never want the portfolio to be overly exposed to 2 or 3 names, despite our long-term conviction. So if we hadn't trimmed those names, I think they would probably be close to be 20% of the portfolio. So we have been, valuations is a core way of us controlling risk within the portfolio, and we're not purely looking at valuations at a short-term price to earnings perspective. I think by doing so, you are, sometimes missing the wood for the trees, especially in smaller names where you have wonderfully long-term people building franchises with 10-20 year growth profile ahead of them. So for us, when we're thinking about valuations, we are asking ourselves, what could this company be worth to us over the next 10 years, and working back from there with, in our view, relatively conservative assumptions, rather than being, like I said, overly focused on a short-term price to earnings ratio. The largest company in the portfolio, Mahindra, we still believe is very reasonably valued, given its ambition to grow earnings 15 to 20%, and with a very strong core franchise of leading market share in tractors over the last 4 decades, spitting out wonderful amounts of cash, and using that to really raise the bar of performance across the conglomerate as a whole. So yeah, valuations has been a key consideration for us in India over the last 2 or 3 years. It's not something that we close our eyes to, and you have seen that underlying the Indian exposure, an evolution of holdings based on where we see the valuations being more attractive.
Great. We're running out of time a little bit, but might try and squeeze in a couple of final questions if that's okay, Doug. A couple of people have asked about gearing. Given you've got a long-term time horizon, doesn't that make gearing a reasonable option? And maybe at the same time, do you have any policy on the discount, or any activity on the discount that you can tell us about?
Thank you. Yeah, so the trust has never utilized gearing, and as you say, that would be it's a constant consideration that we have. But for us, like I said, the philosophy and our want to be the best investors in Asia over the long term, driven by that ability to protect capital on the downside and participate in upside growth. For us, taking on gearing really amplifies that downside element of the proposition, and yeah, we've never utilized it because of what it would do to the outcomes that we're looking to offer clients. It's a constant source of debates, but yeah, for the history of the trust, we've never utilized debt. In terms of discount management, I know that the board is very keen to be seen to do as much as possible to manage that discount, and I think there has been a record amount of buybacks in the last few months. For us as investors, we're very much focused on trying to deliver that consistent philosophy and the consistency of long-term returns. I think that's the only thing that we hope the best outcomes for our energy, and by offering hopefully an attractive home to long-term capital in Asia, and consistently delivering those attractive long-term risk-adjusted returns that the trust should see demand for it. That's not, that as managers, that's what we're focusing on. But I think if you were to see the number of buybacks that the trust has performed over the last 6 months, it has been a bit of an outlier versus history.
Maybe one final question, if we can take up a tiny bit more of your time, but could you perhaps end by giving us a bit of your thoughts on the outlook? So I think maybe something that came up a couple of times in your presentation was maybe the fact that Asia's been just a little bit overlooked. Obviously the attention's been in the US and elsewhere.
Yep.
But as we kind of survey the region now, there are clearly issues that people are concerned around tariffs and geopolitical tensions. How do you view the market as a whole right now compared to how it has been in previous years?
Well, I think if you were to look back at the Asian markets of the last 10, 20 years, there's always been something to worry about, and we're always looking at focusing on what we can control and what that bottom up opportunity set is. And we've touched on that opportunity in India. I do think there's the wonderful opportunities for growing profit pools in India, whether it's driven by that large consumer base, which is on some levels comparable to where China was in 2006. There's wonderful industrial companies that have the ability not only to benefit from domestic growth, but take on slow, bureaucratic European and US companies. And I think that's something that's very different to the past. When we are looking at companies within Asia, that there's not this simple focus on domestic growth, and these aren't companies that are hiding behind protective barriers. They are looking to be going out and be globally competitive, which massively for us increases that opportunity set and for profit growth. I've made a point on on foreign investors' view of India. I do think that's a potential very attractive longer term tailwind if you see some movement on asset allocators' part to shift away from the US, and everybody looks at India as being expensive. But you've got opportunities for margin expansion, opportunities for top line growth. In many companies that we own, seeing some opportunity for valuation re-rating. It's very difficult to see that in the US at the moment. Southeast Asia is definitely another place where we see as an attractive driving force for future returns for the trust in Asia, and it's very much the land where foreign investors have forgot. I think foreign investors again have been selling Southeast Asia non-stop for the last 5 years, and the Filipino stock market is on less than 10 times earnings. The Indonesian market again, very reasonable valuations for some wonderful small and mid caps there. So at the moment that's where we're spending the bulk of our time, looking at companies that have the ability to grow 10-15% on 10 or 15 times earnings, and these are just not opportunities that you find in the US at the moment. But in an Asian context, you need to take an active approach. The index is full of Chinese state-owned banks, oil and gas companies, the internet companies, which are largely state-controlled. So I do think that the largest companies in the index, unlike perhaps the US, where you are having exposure to companies that are changing the world in a number of ways, in Asia, the opportunity set at the top of the market is not going to give you that exposure to those wonderful growing profit pools. I do think that bottom-up approach and finding really long-term people, which again is a real competitive advantage for us in Asia, and that there just isn't that short-term time horizon and short-term focus that's crept into the US management teams that we find in Asia. So yeah, I mean, for us, it's the same old, like, wonderful long-term opportunity, some of the best franchises and the best people that we can find globally, with attractive amounts of growth available at a point in time where just everybody has given up, I think, on Asia.
Brilliant. Well, yeah, thanks very much, Doug. Great note on which to end it. And thanks for your presentation. Thank you to everyone in the audience for your questions and your interest. Hopefully you will join us tomorrow, where we'll be hearing from Scottish American and Schroeder Oriental Income. But that's all for now. Thanks again, Doug, and I hope everyone has a great afternoon. Bye, everyone.
Thank you very much.